past 5 years, according to the Commission, 1.7 trillion euro has been spent bailing out banks, and I think it's about 3 times that amount has actually been put up as guarantees.
One key lesson of crisis management, and this goes well beyond the euro area, this is a general factor, is that in order to minimize the economic cost of financial crisis, there needs to be a rapid allocation of losses.
Harold Bennick, the Dutch finance academic, said recently in a Financial Times article that the European banks had unrecognized losses on their assets of at least several hundred billion. That's a quote. And from other work that he's been involved in, we see that there are very large amounts of toxic assets from the beginning of the crisis, amongst others. So my question then related to that is, why wasn't this dealt with at the beginning of the crisis, and when, if ever, will it be done?
Cleaning up the balance sheets of the banks. I think this gets us to the heart of the problem, I believe. I think you will find very few economists who would argue, well, it's better not to clean up your balance sheet and to keep toxic assets in your banks. I've also seen these articles. I must say I find it difficult, also from my position, to put exact numbers on these assets. I think we would need another review to get to this. But in the abstract, I would agree that it is important that we dispel any doubt about the health of these balance sheets.
Press release as of February 2008, European banks are well capitalized. I don't think Maarten said that. The origin of the current financial turmoil came from the US subprime, not us. And a large portion of the European financial sector is not directly affected. Where financial institutions have sizable direct exposures to the US subprime market, or indirect exposures, the affected entities have well-diversified portfolios and large capital buffers. So say the hooligans. What is the reality? The most shocking, this is Wolfgang Munchau, the most shocking news from last week's excellent Global Financial Stability Report was not the headline estimate of bad assets. Much more shocking was that the lion's share of these assets belong to European, not North American banks. Of the total 4 trillion, the global banking system accounts for 3 trillion. Of that, a little over half is sitting in European banks, or US banks account for only 1 trillion. You get the picture. All these data tell us that Europe is both the biggest problem and has made the least progress. So this is the reality. This is not something that is due to national supervision or the fragmentation. This is something which is largely due to a gung-ho, breakneck, reckless, deregulatory integration drive.
So far, what we've discussed is mostly supervision. I think it's very, very important that we take as a starting point that supervision is a very interesting subject, but if the rules are flawed, what is supervision worth?
We see in times of crisis the national resolution authorities and national supervisors are predominantly national, and they look out for the narrow national interest. And this very often stands in the way of finding more cooperative solutions which could benefit all the parties involved. And this is clearly one of the key objectives that we're trying to achieve.
There is a case for criticizing national regulators. The question here, though, should be why would we expect something completely different from the European Central Bank? Is it that the European Central Bank is not close to banks? I can mention a few people pretty high up in the European Central Bank that are very, very close to some of the very, very biggest banks in the world.
I'd like to point out that citizens get back a lot in return. Because by giving up a little bit of the sovereignty, one has better assurances that the banks in neighboring countries are properly supervised. And there's less chance that you will be affected by financial developments that have originated elsewhere.
What the Germans would not like to do at this stage is to put German money into a resolution fund that would go to Spain or to Italy or wherever, unless it seems that unless this is coupled with even more strict conditions on member states' economic policies, unless it can be seen as a step towards another element of the whole economic governance architecture, a fiscal union.
Removing restrictions on maximum mortgage interest rates would allow a subprime mortgage market to grow. There you have it. That was their policy. Alexander Lamfalussy says stability is forget stability. What we need is subprime. Yeah?